All right. Hello, this is Josh Belk with the Belk on Business podcast. On today's podcast, we have the opportunity to have a gentleman who I guess we probably met maybe a year and a half or so ago in I think we were out west at an event. And I think maybe I think all the people in that room, you were an extra special blessing to me because you kind of struck up a little bit of went out of your way to strike up a conversation with my son. And that kind of was extra special to me, and it kind of spoke to the heart of the type of an individual that you are. So his name's Jack Krupey. So I'll allow for him to tell a little bit of his story here in just a moment. I'll read his bio and then we'll kind of get right into it. What we're going to try to do today on the podcast is kind of just give a little bit of a primer, not really go into a deep dive, but a little bit of a primer on funds. And Jack has the opportunity. He does have different funds. He helps as far as gathering together investors and finding places to where they can place their capital. And we'll talk a little bit about through if you have questions in regards to what is a fund, we'll try to address that just a little bit. Or maybe you're in funds and kind of maybe looking for another opportunity. Jack would be the perfect person to connect with. So Jack Krupey. Jack has been investing both in real estate and distressed debt since 2001. He has built long-term relationships with experienced real estate developers, sponsors, and syndicators over his 20-year career. Jack leveraged the 2008 financial crisis as part of a private equity fund that yielded impressive returns off distressed and restructured debt. He repositioned properties as well as modified and structured loan for borrowers. In 2014, Jack entered into a partnership with a large private equity fund and led the asset management arm of the firm that made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2015 and 2019. As an entrepreneur by nature, Jack decided to start JK Asset Management to focus on alternative assets such as value-add multifamily real estate. He then launched the JKAM Diversified Real Estate Fund in September 2000 and is launching a second diversified fund in 2022. As I went through and I read this bio that you kind of have out there publicly, one thing I thought was really interesting is you kind of got your career started in a place that we may be finding ourselves here coming up. We're already starting to see interest rates go up. I think we're really going to start to see some issues in the real estate market in coming months. And I think it's kind of the perfect timing maybe to have you on at this point, since we may be facing here in the coming months and in the coming years something similar, not exactly to 2008, but we're going to start to see, I think, some correction in the real estate market. We may end up seeing a situation to where we may end up with some mortgage issues like we did back at that time frame as well. And you bring a lot of experience as it relates to how to handle and work through that crisis. Maybe we'll get into that a little bit in this podcast. So first of all, Jack, let's kind of get to know you a little bit. Tell us a little bit about your journey from if there's maybe an aspect of your childhood, but maybe from your college time and then through your career path that kind of brought you to where you're at today.
Sure. Great. And Josh, thank you so much for having me. I'm really excited to do this. I always had a little bit of an entrepreneurial flair. Actually thought I was going to go more into the IT industry. So I have a degree in information technology. And when I graduated in 2001, it was the .com crash. So was fortunate to have a job, had a decent W-2 income, but it wasn't as exciting as I thought it was going to be a few years earlier, where people were getting flown all over the world, Silicon Valley. It was sort of the .com crash, but the start of the first real estate boom. So I bought a book about no money down real estate and called my landlord. I was still living in Rochester after college, even though I'm from the New York City area. And within a month, I bought a house, no money down. And within another year, I'd owned 4 or 5 of them and really lived that infomercial dream from 2002 or 3 till the crash of 2007, 2008. So really cut my teeth on traditional real estate, fix and flip. I'd gotten my real estate broker's license, did some wholesaling, and really all the retail kind of initial entry-level real estate strategies I did in my early to mid 20s. And during the crash, private equity funds needed real estate people. They were buying hundreds of thousands of non-performing mortgages at the start of the foreclosure crisis. And they needed people like me. I never thought I was going to be a Wall Street guy. But they needed the kind of Main Street type real estate brokers who were on the other side buying foreclosures to really represent the funds and the banks to ensure that they, could handle these mortgages and had someone that understood the retail side of the investor market. So it was really kind of a crazy way to kind of back into private equity.
And so from there, you were actually kind of doing this for, for someone else. So essentially why did you end up deciding just to kind of start your own funds, to kind of transition from working from somebody else or partnering with someone else into this, to kind of just starting up your own company and doing this on your own?
Sure. So there's a couple different levels of that. I worked for a firm for about 2 years, and then went on my own for the first time. And, I'm an entrepreneurial person at heart. End of the day, I saw the money that was being made by some of the other investors that were buying loans from this company. So decided I wanted to go on my own and try to do that. So I did that for about a year on my own, and then partnered with a family office. And then we risked a few $2 to $5 million buying loans, doing loan modifications. Our goal was always to help the borrower stay in their house if they could. And many people got caught in the foreclosure crisis where they lost their job and they have a new job they could afford to pay, but they couldn't afford to maybe pay $20,000 to reinstate the entire loan, but they could easily afford a mortgage payment. So we worked out a lot of win-win scenarios, and we would modify the loans. And once the loan was modified, after about a year, you could sell the loan back to Wall Street at a profit. And it turned out we generally made more money flipping the loans than we did actually foreclosing. And in some situations we had to, unfortunately, because 2005, 2006, there was a lot of people who probably never should have got a mortgage. There was a lot of programs that, were really borderline fraudulent, or in some cases fraudulent. So that was one of the unfortunate causes of the financial crisis. So, went from, my own small firm to partnering with a family office to partnering with a large private equity fund that was looking to deploy capital into the space. So never really expected to be involved with $1 billion type of fund. It just sort of, came together through, just our being active in the space, and being in New York City. It didn't hurt, just because it's just the center of the finance world. So, was just fortunate to, find the right people to partner with, and, bought over $3 billion worth of loans. So it was amazing experience, but sometimes the grass isn't always greener. As you get to a certain size and scale and infrastructure, it becomes, the compliance gets more costly, and it becomes, you can create a monster in some cases. So if you have an entrepreneurial spirit, sometimes you get too big to a size where you kind of can create yourself a trap if you're not careful.
What type of assets would generally someone put into a fund? And then what type of assets? I know you have alternative investments in your company name. So we think of kind of traditional investments. I think a lot of times when you think of a fund, they're thinking, they're either it's a bunch of maybe single family homes, or maybe it's commercial properties, or it's hotels, or whatever. But so you kind of think of those more traditional types of investing. And then what are some of the things that you're doing, and maybe instead of that, or in addition to those types of funds? And maybe we should take a step back and kind of maybe just give a real high level, what exactly is a fund?
Sure. And there's multiple types of funds, but our fund is essentially, it's just a company that is set up specifically for a purpose of investing. And there's, an operating agreement, and then there's generally a disclosure form called a private placement that describes really the business plan of the fund. And there's many different structures, but most funds, at least the private funds, the syndications, the types of deals I'm involved with, are generally just formed as an LLC. And, when someone invests, they become a member of the LLC. As you get larger, much larger, there's other structures like REITs. It's more of a tax treatment thing. But really just think of it as a private company. It's the simplest way to think about it. And, our funds are all structured as LLCs. And if people invest and partner with us, they truly become a partner. They're a member of the company alongside of us. So it's basically a way for either individuals or entities to be able to come into an investment without buying the whole investment, essentially. So they can come in and maybe buy a portion of this portfolio, or a portion of this property, whatever the case may be, through ownership of that LLC. So it's almost like a pooling type of an effect. Exactly. That's a very, very simple and great way to put it. It was surprisingly a little simpler than I thought, and we'll get into kind of how we put this together. But it's gotten a lot easier in recent years to structure funds and put things together. These used to be sort of backroom country club type opportunities that were hard to find unless you had a lot of access. But with some rule changes and the internet, I believe it was 2012, they really changed the regulations that it really made private funds a lot more accessible to the general public. And I think it's a great thing because, largely the more niche the opportunity is, the less it's publicly advertised all over CNBC or on the news. Usually the returns are better for sort of smaller, more niche opportunities than they are for like the widest publicly available stocks or mutual funds.
So what type of investments are you putting into your funds?
Yeah, so we focus over the last few years, we focus very heavily on multifamily apartment buildings. What I've learned over time is that in many cases, bigger is better. When we were in the mortgage business, it was, again, we would buy 30,000 loans in some cases. And, once you have the size and scale, it's easier to operate. So I'd invested when I was in my 20s in single family, 2-family houses. And, as I started investing more in apartment buildings, when I lived in New York, we were investing in buildings in North and South Carolina, Georgia, Florida. Once you're above 100 units, those apartment buildings generally they support on-site management. So it's really like owning a business. And at that size and scale, you have a lot less headaches. You're not getting the call at 2 a.m. about a clogged toilet because you have an on-site manager or a superintendent, versus when I'd had, a bunch of single family houses, I would get those calls. And, it's not, it becomes, if you're not careful, you can create yourself, a job you hate. So we focus on apartment buildings, and what we generally focus on are buildings that are fully occupied or 90% occupied, not really, in distress, if you will, but they're old and tired. So we call it a value add strategy. And if you buy an apartment building that was, say, built in the 70s or 80s, and the prior owner, it was clean, it's a decent building, but they weren't really renovating the kitchens, the bathrooms, that, you have the same cabinets from the 80s. And what we will do is we'll come in and we'll update the flooring, the kitchens, and the bathrooms, and just really pretty up the units. Maybe spend $5,000 to $10,000 per unit. And what we're finding is there's a shortage of quality housing, especially in the middle class, because of the cost of construction, and very few workforce housing buildings are being built at this point. Most of the new construction is very high end. So we're finding there's a huge demand for very high quality but middle class apartments, and that's a large part of our focus. And it's been very successful over recent years. We also like mobile home parks, self-storage, private lending, sometimes referred to as hard money lending, and some industrial. Industrial is a great and growing area, and I think with some of the things going on in the world, we're very bullish on industrial, because my gut says there's going to be some more onshoring of manufacturing in the coming years, with price of oil, with some of the geopolitical issues with COVID, with supply chains. So those are the key areas of that we've tended to focus on over the last few years.
Interesting. So it sounds like you have a pretty diverse, as far as options out there, as far as somebody wants to come in and invest in a fund, as far as the direction they're wanting to go. And we'll get a little bit into the tax side and maybe the reasons why you may want to go one direction or another here in a moment. But why would someone want to go into a fund versus just simply going after it themselves? I mean, we have clients at the firm level, they go out and they buy apartment complexes on their own, but most of them would choose to go this direction. But from what you've seen, why would someone rather go and invest in a fund versus trying to go and just kind of do it themselves and maybe keep more of the profits, in theory, for themselves?
Yeah, and look, it depends on sort of the personality type. There are certain people that really like to be hands-on and dive in and do things themselves. But I've cautioned a lot of investors that it's not always as easy as you think. And if you have a successful business or you're a high earning professional, in some cases, it's not worth your time to try to do things yourself, because it can be a lot more hassle than you think, especially if you're a one-man show and you're just trying to juggle a full-time job or a full-time business you run plus investing. The other thing is deal flow. I mean, we're full-time in the business of reviewing deals, working with multiple partners. So we have access to a lot of opportunities that cross our desks. And our position, because we're a more diversified fund and we invest with a number of very successful, very experienced operators, we're often investing with the group that might get the off-market deal the really distressed deal, or they're getting the last look where, because they own other buildings in the area, they have the reputation that's going to get them the deal over someone else. So, often, anything you may sacrifice on having to, split a portion of the profits or have any sort of fund fees, our goal is to, to surpass that by just generating better returns and having a higher quality opportunity, just through our network. And because we spend, full time between traveling to different masterminds, networking with various partners and operators, getting, the most up-to-date financial updates on markets and what's happening in the real estate market and in the financial markets. So, it's really, you're paying for our network. You're partnering with us because of our network, our access, our own expertise. And, in our case specifically, I also have a lot of my own money in the fund. I really created the fund around my own personal investing once I left Wall Street. So, I look at ourselves, I look at our business as really a partnership more than a company.
So somebody wants to go in and invest in a fund. Are there certain basically qualifiers that they have to get in, maybe by amount of money that they have to put into the fund or the amount of money they make? I know we hear, these terms as far as accredited, non-accredited. So what are some of the qualifiers as far as both working with you or maybe in general, if people are looking as far as investing into a fund?
Sure. Yes. We are only able to accept accredited investors, and it's something through the government and through the SEC, where if you do advertising, you have to prove that your investor, you have to get some type of proof from your investor that they're accredited. And what that means is, if you're single, it means you make at least $200,000 a year for the last 2 years. If you're married, it's $300,000 combined, or have a $1 million net worth. And that excludes the primary residence, but it includes everything else, whether it's investment properties, even 401k IRAs, other assets, a business you own. And it's a very minimal process. I mean, for us, we usually just ask the investor to have their CPA send a letter that they meet the criteria. We even use a third party to verify, because I don't need to look at tax returns. I don't need to see anything else from our investors other than that they're qualified. So we make it very, very simple and straightforward. And a majority of our investors haven't had an issue. And unfortunately, those that are sort of up and coming and trying to become accredited, there's a lot less options. There's a few that are what's called a Reg A. There's a few online ones that it's almost like being a public company at that point. The amount of legal work to accept non-accredited investors is daunting. So we found it wasn't really worth the legal fees for us to go through. But it's still, the laws changed in 2012 that made it a lot easier for investors to find these types of private deals. So it's still been a large improvement over the last 10 years compared to what it had been in history before.
Yeah, I think that's one thing that I want to point out, because of course, as an accounting firm here, we put out accreditation letters quite often. I would say there's probably, we're probably a couple of them a week at least that we send out for our clients. And it's kind of one of those things, sometimes people they feel like they're offended. Oh, you don't want my money, or whatever the case may be, but kind of realize that all these rules are dictated by the SEC. And so when you have a fund manager dealing with a fund, that type of thing, and they ask that type of a question, it's because they essentially have to remain compliant on their end. And I get into Reg A and Reg B and, and the 506 and all these different numbers out there that confuse people. That's not necessarily important for the investor, but there's a lot that goes on out there, and just kind of want to be aware that you really kind of do need to meet these minimum thresholds. And of course, Jack spoke to to what they are: $200,000 the last 2 years if you're single, $300,000 adjusted gross income if you're married, or you have $1 million as far as net worth, and that does exclude your primary residence. So if you have a lot of equity in your business, for example, or if you have investment properties currently that maybe would appraise out in excess of that, less your debt, you have enough equity there to where you'd hit that $1 million threshold. And it is a pretty low bar, I think, nowadays, especially for someone to hit. So now, what are the potential tax benefits? And before I put this out there, we are not giving tax advice here. So we're just going to talk a little bit about just generally, just to have a conversation a little bit about some of the potential tax benefits. You may or may not be able to reap these benefits. It's something definitely you'll want to talk to your own accountant and see whether or not this particular situation would apply to you. But as we kind of talk about this, Jack, I know that people come to you for different reasons, but why? Maybe for tax reasons. This is one of the primary reasons that we see that people want to get into investing in funds. But there are other reasons we can talk about as well. But what are some of the potential tax benefits that you've seen out there that people may reap when they get into investing into a fund?
Yeah, I mean, the tax benefits are really amazing for these types of structured funds. And I really got into the syndication and these private funds while I was still working in New York in my prior business, because in New York City, when you factor in the federal government, the state government, and the city, I was paying 50% tax rate. And I was looking for investments that were tax efficient. So the number one thing is a majority of the income that you get, whether it's a monthly or quarterly distribution, is generally deferred completely by depreciation. So real estate is one of the few assets that actually goes up in value, but on the first year especially, you could take a significant amount of depreciation benefit. So you show a loss on paper. And it's one of the few assets that you show a loss on paper, but it actually goes up. If you do it on a truck or other things, most of the time you are eventually taking the loss. And with larger real estate, probably the biggest differentiator for doing a 100-unit building or as a partner versus just buying a single family house is you can accelerate the depreciation. So on these 100 to 200 unit buildings, it's not out of the question that we receive almost 100% of our investment as a paper loss year one. And so you invest 100,000. We've had deals where we got 98,000 as a loss right away in the first year. And if you're able to take advantage of those tax benefits, you might be saving between 37 and 50% in taxes that first year. Now there's some limitations that you said. This is not exactly taxes. This is not official tax advice, but the people that are truly the best capable of taking advantage of this are real estate professionals. That means if you're a real estate broker or your spouse is a real estate broker, or if you own enough properties that you're actively managing and you spend, I believe it's 750 hours a year managing properties, then you're considered a real estate professional and you're able to take all of those losses immediately that year. If you're a high W-2 income earner and neither you or your spouse is a professional, let's say you're just a doctor, you're a lawyer, you're limited to the amount of passive losses you can take. So you can't offset your active full-time salary, but you can offset any other passive income. So if you own other properties, if you sell one property for a profit, then you reinvest into a fund, you can often offset the income from that other property by taking the tax losses. That's the main one that most of our investors are excited about taking advantage of. And there's other niches like 1031 exchange, ways to sell one property and buy another one. But the depreciation is really, really powerful as far as, getting current cash flow, but not having to pay tax. Even if you are that high earning person, if you're getting paid the rent every year, you're still showing a loss on paper. So the rent you're receiving is essentially tax deferred largely until the property sells.
So and someone out there may have the question in regards to how in the world does that work, that, you go through and you can take all this accelerated depreciation. And so a few years ago, of course, there was put into the code the ability to be able to essentially take an asset and break it down into smaller components. And so kind of go through, and not to get into a deep dive here on depreciation, but normally a commercial property would be depreciated for tax purposes over 39 years, a residential property over 27 and a half years. But there are certain aspects of that property. So it may be cabinets, it may be carpeting, it may be flooring, that type of thing that would be allowed to be depreciated over a shorter timeline. And that might be 5 years, 7 years, or 15 years. And so if a piece of that property fits within one of those 5-year, 7-year, or 15-year timelines for depreciation purposes, currently the tax code allows for 100% of that depreciation to be taken in year one. And so, and not to get once again into a deep dive here on depreciation, recapture, that type of thing. Generally, there's a timeline that people would need to stay into this in order for it to really make sense. Can you speak to that a little bit? So somebody's wanting to go in and say, okay, I want to get in, but I want to get out. I want to get my money back in year two. What is ideally the timeline? I mean, do you require somebody to stay in the fund for a certain amount of time? And then from a practical end, how long should someone stay into a fund before they decide to sell their position?
Sure. So yeah, our funds and a majority of, we have a fund and we also have some options to go deal by deal, but largely I would call them closed-end funds. These are not funds that you can just click a button and sell and have liquidity. You're usually in until the property sells. So that could be in general between 3 and 7 years, depending on the project. And for the fund, it tends to be about the same because it's blended between projects that are 3 to 7 years. So, we do tell investors, don't put in money that you're going to need to, expecting to withdraw in 6 months. That's part of the reason there's better tax benefits and that largely the returns are superior to what traditional average 8 to 10% that Wall Street has made over the last 50 years, because you are sacrificing that one aspect, which is liquidity. So it's generally a 5 to 7 year play. One of the cool things that can happen is if the property is refinanced, that's not a taxable event. So there's been many situations where there's, the properties, the value's improved. We've renovated a bunch of apartments, done that value add that I've mentioned, keep mentioning in this talk. And we've had situations where sometimes half to, in rare situations, even all money can be returned and we still own the asset. And that's completely a tax-free event. The recapture that you mentioned only happens at the property sale. And, it's worked really well for, a lot of our investors are, in their 50s and are maybe eyeing retirement in the next 5 to 10 years. And, the great thing about recapture is if in 5 to 7 years, you may be slowing down or even moving to a lower tax state. If you're deferring taxes at 37 to 50%, and then in 5 years, you may, maybe you or your spouse retires and your tax bracket's now 12% because you're going to make a lot less money. It can be a pretty powerful tool for tax deferral and tax savings.
So what other reasons may, besides tax benefits, would someone get in? And I think that you probably touched on most of this here, but you talk about appreciation, and a little bit about the return. So if somebody wants to get into a fund, do you always in your funds go through and either do cost segs or break those down into smaller components? Or do you have funds there that you put together and say, okay, this is for someone who's not necessarily for the tax benefit, they're just looking for the appreciation and the ROI?
Yeah, we have a combination of options. We even have a private lending fund, which doesn't really have the tax benefits, but it provides just consistent monthly cash flow, and that has actually a little more liquidity. So it's a combination of cash flow and growth. Certain projects don't have as much current cash flow because of the cost of the renovations, whereas other ones are more just mailbox money, where it's it's bought, it's stabilized. You just get a check every month or every quarter. So we pretty much, we want to be able to cater to a majority of investor needs. Some people just want growth and appreciation. Others really want that cash flow and that mailbox money. Some care about taxes. Others, a lot of people are using self-directed IRAs as well. There's a number of groups, and just so to be clear, if you're working currently and you have your 401k with your company, it's usually locked there. But if and when you leave that job, you have the option to roll that IRA over. And many people might roll it over to Fidelity or whatever their broker is. But there's a number of niche custodians that will allow you to take control of your IRA. And then you can decide to invest it in real estate. You could do private lending. You can still do stocks if you want to, but the self-directed IRA market is very, very, very powerful. And I know a number of our investors have taken advantage of that. It's a very powerful way to control have control of your retirement account and, pull it out of Wall Street. To go to your initial question, like some of the other benefits are, the stock market, as we record this, is down over 20% for the year. The volatility in real estate is significantly less. I say that I've lived through 2008. I know anything can happen, but I do think that was sort of a once in a probably our lifetimes type perfect storm of crash. Things are, to me, a lot different this time. We didn't have the loose lending standards that we did previously. Real estate's a hedge against inflation as well. Many of our loans were locked in with low rates, and if inflation does continue at 5, 10, whatever percent is a year, rents will continue to have to go up. The values, will go up, and the debt, we're paying back debt at 3%, 4% in some cases. That in 5 years, that loan payment doesn't move until until we have to sell the property. So, those are most of the, benefits is taxes, inflation hedge, appreciation, and not tied to the stock market as far as day-to-day volatility.
And I think it's a powerful thing you mentioned there. And it's something else that there are some people that don't realize that they can take their retirement account, and if they are able to self-direct it. And so you may need a custodian. We actually had a podcast guest on here a number of months ago that talked about how you can be your own custodian, that type of thing. But really, you can take ownership of that money, because a lot of people think, my 401k, my SEP, my simple, whatever it is that I have, that the only thing I can do with that is invest in the stock market with it. And so I'm kind of stuck there. But that's not always the case. I mean, you can take that money, you can self-direct it, and you need some help. So you're going to need to have an accountant. And if you go to your financial advisor, they're probably going to, push down this idea, because they make benefit, taking that money and putting it into the stock market. So you want to make sure that you're aligned with people that kind of understand there are other things that you can do. And so to be able to take ownership of that money, work with a custodian that can help you self-direct it. And then you can go through and take those funds. So if you have $100,000, you have $250,000 in your retirement account, you're able to take that money and put it into a fund. It's not in the stock market, which is very, very volatile, and put it into a place to where most of the wealthiest people out there are invested in real estate. And so you go through, and of course you are going to see in time, generally appreciation. In the short term, that may not be the case. We may see a correction, that type of thing. But if you're in it 3 to 5 to 7+ years, it's going to rebound. You're going to see the appreciation. You're going to have, in all probability, an ROI higher than the stock market. Somebody else is paying that debt, essentially the tenant. So they're paying their rents every month, whatever the case may be there. That money is taken, pays off the mortgage. You're seeing the appreciation. It was kind of a win-win, I think, for everyone that's involved. And of course, in this market environment, we're seeing younger people that prefer to rent over own. You talked earlier about earlier in the podcast, just from a market end, more individuals, younger individuals now, they're not necessarily looking to buy. They're happier just to rent a place. And that's where someone like you can come in. You buy those properties, you get them remodeled, and then really just kind of help the overall market in far as directing some of the housing shortage that is out there. Jack, I usually, when I'm kind of wrapping up a podcast, before we get into as far as how can people connect with you, I generally ask this question, especially to those who are entrepreneurs that we bring onto the podcast. So you've worked with a number of entrepreneurs from those basically in that startup phase to those running a 7, 8, 9, 10-figure business. What are the top reasons that you've seen why a business owner either succeeds or fails?
Yeah, I mean, first things first, and this is sort of a kind of a business school cliche, but having a product market fit. I've heard a number of startup ideas where it's like, is there really a need for this? And that tends to happen. It happened a little bit in the .com crash. It's been, I've seen a bunch of random cryptocurrency pitches where it's like, okay, is this really needed? You could do this in crypto, but you could also just do it with a database. It's really nothing new and exciting. So first things first is you need to have, know that there's a need out there for the product and that there's a fit for it. And, the next thing is play into your strengths. Whether not every entrepreneur is like the crazy networking salesperson, there's plenty of introverts who've just been very successful at just building and managing and scaling. The last thing is just not running out of money, being well enough capitalized. Some of the struggles I had in my mid-20s where it was a bootstrapped business. And a piece of advice I got from someone who was kind of looking at, just a mentor of mine who was looking at our business, and he was like, everything about your business is great, but you're undercapitalized. And that's a major risk for young up and coming business owners that oftentimes try to scale too quickly. And if you don't have the right backing to scale, you could have a great business where everything is going well, but if you run out of money, and then it's game over. So it's probably how a majority of businesses have failed, is from being undercapitalized more so than anything else.
Thanks for sharing that. It's definitely a different answer than I've heard in the past. So it is one thing I think from a consultant's end, working with clients, that we talk about a lot is really kind of taking a look at that cash position. Do they have the necessary cash there? Because especially, we talk about real estate investors, they want to take that money and immediately deploy it. And sometimes they fail to realize that, you know what, you do need to hold some of that back to make sure that you are, that your business has enough cash there to operate, and that there is some cash and reserves just in case there are some unforeseen issues that you run into, and to make sure that there is adequate capitalization. I think I remember from your bio, read that you went to Northwestern, that here just outside of Chicago.
Yeah. I actually did their global MBA program. So
Okay.
I spent some time in Chicago, but I was also able to spend some time in Hong Kong in 2018, 2019. So it was an interesting time. The protests were starting. It was before COVID, obviously, but it was still a interesting time. And then took a venture capital course in Tel Aviv, Israel, which is other than Silicon Valley, is one of the top venture capital technology markets in the world. So it was a great year and just a great way to get exposure to many different students, investors, professors from all over the world. It was a heck of an experience.
Yeah, where I sit, my office is just outside of Chicago in Northwest Indiana, and I went to Purdue University. So a different Big Ten school. But I saw that out there. I just wanted to throw that. It was really, really interesting. So Jack, someone wants to connect with you. I know you have your own podcast, if you want to mention that, but also how can someone get in touch with you if they so choose to do so?
Sure. Thank you. So yeah, we're launching a podcast called the Alternative Investor Mastermind. And we'll talk about a lot of the same things, really all alternative investments, not the traditional stocks, bonds, kind of basic stuff. So it's going to be real estate syndications. We'll talk crypto, we'll talk options trading, we'll talk real estate syndication deals, really just everything that's a little bit niche-y, that's a little bit harder to find quality information. Our website is jkaminvestments.com. That's JKAM for JK Asset Management, jkaminvestments.com. We have a Facebook page. We're on LinkedIn. We're on pretty much everything but TikTok. I know I should, I feel like I'm a bit old for it, but apparently a lot more people are also starting to post on TikTok. So I may have to bite the bullet and get on TikTok as well. Love to chat with investors. It's, we just take a consultative approach. I'm often, again, I'm not an official financial advisor or tax planner, but I like to dive in and understand someone, as much as someone's willing to share. I'll say, hey, ask your accountant, what's your Schedule E income for this year? And that basically tells us how much income we may be able to help offset through depreciation. So we really just love to mastermind. We look at it as as a mini mastermind with our friends and clients, and just really enjoy what we do. So invite anyone to reach out and just, sign up for our mailing list, follow us on your platform of choice.
Wonderful. We'll put that contact information in the show notes as well. You can get in touch with Jack, and I encourage you to, if something you're interested in, as he gets his podcast up and running, support him and listen to his podcast. Jack, once again, greatly appreciate you having you on, and look forward to connecting again at some point in the future.
Absolutely. Thank you so much.
All right. So this is Josh Belk with the Belk on Business podcast. Once again, thank you for listening in today. This particular podcast brought you value. Please consider subscribing. Take care of yourself.